Hello, it's me, Kenny Polcari, your host of the party, and today is Friday, July 22nd, 2022. It is the end of what has been a very long week. So what is it that you need to know to get your day started so you understand where we're going, where we've been, and where we are, all right? Yesterday, the ECB raised rates by 50 basis points, and they introduced a new initiative, right? Something we'll talk about. Draghi, Italian Prime Minister Draghi, resigned. Italy to hold snap elections out on September 25th. And speaking of snap snapped last night. Stock is down 27% in one move as they missed across every metric you can imagine. And as our AT&T customers getting ready for tougher times ahead? And are they telling us something? And what are we having for dinner tonight? We're going to have the pan-seared ribeye bathed in butter. Oh, so delicious. Okay, look, the European Central Bank raised rates by 50 basis points yesterday versus the 25 that Christine Lagarde had been telling everyone for months. The fact that inflation now running at 9.1% across the Eurozone is at record highs is at the root of that decision. She then introduced a new concept into the central banking narrative, the Transmission Protection Instrument, now known as the TPI, just another acronym you need to get used to. It's another tool in the toolbox, which is supposed to ensure that the monetary policy stance is transmitted smoothly across all the Eurozone countries. It can be activated to counter unwarranted, disorderly market dynamics that pose a serious threat to the transmission of monetary policy, and it will allow the ECB Governing Council to more effectively deliver on its price stability mandate. Sounds a lot like, oh boy, we're in serious trouble and we don't know what to do now, so we're going to produce a new, complicated program to divert attention away from the fact that we're screwed. In any event, the TPI will buy the debt of the most vulnerable European economies as it tries to protect the Eurozone as it navigates the twin threats of skyrocketing inflation and slowing economic growth. Lagarde also made it clear that the ECB does not expect a recession this year or next year. Well, that's nice. We can only hope. I can't wait to see how this instrument protects against 13 years worth of bond market stimulus and artificially low interest rates, negative in Europe, that have completely disoriented and disrupted the European financial system. Never mind what the other ones did to the rest of the global system. But hey, let us give her some space and see where this goes. I mean, what could possibly go wrong? And while we're in Europe, yesterday we also saw that Italian Prime Minister, Uncle Mario Draghi, called it quits as support for his government collapsed and inflation, which is now running at 8% in Italy, continues to surge out of control. Italian President Sergio Mattarella is now calling for snap elections on September 25th. And next, Vladimir Putin allowed the Nord Stream pipeline to be turned back on, but at a slower rate than Europe had hoped for. But I guess it's better than not turning it on at all. So let's just try to move on and see where that goes. And at home, on the economic front, we saw the Philly Fed survey decline by 12.3 points versus the expected increase of a 0.8. And the leading economic indicators fell by 0.8%, more than expected. Both are signs of a slowing U.S. economy. And guess what? AT&T reported earnings. And yes, the report shows that they beat on the bottom line, reporting earnings per share of 65 cents versus expected 61. They made sure to tell us that they raised their forecast for mobility revenue growth while lowering their full-year cash flow as they ramp up investments in their 5G network. They also revealed that revenues declined by 17%, which reflects the spin-off of the media division to Warner Brothers Discovery. So that's not new news. And the algos took it down by 7.6% to end the day at $18.92. In fact, they gapped it down on the opening yesterday morning by $1.44 or 7%, finally filling the up gap created in April during the last reporting season. You see, at some point, this all comes out in the wash. So why do you ask did they do that? Well, because they also reported that customers are making late payments on their accounts. And that is cutting into their free cash flow by $2 billion, which then suggests that just maybe AT&T will have to cut its dividend, which is 28 cents a quarter or $1.12 a year, to maintain the robust capital spending on its fiber network. And now we have to ask, could that be the canary in the coal mine concerning the broader economy? Because when economic conditions deteriorate, people prioritize what bills to pay. And when they start making late payments on their cell phones or their cable bills or utilities, that reveals a lot about the underlying economy. So now we're going to see it. We're going to see that same narrative today when Verizon reports, or next week when T-Mobile reports about the late payments. And Blackstone, BX, fell by 5% after reporting disappointing results. Fee-based earnings coming up short of expectations, while total revenues and assets under management were better than expected. In addition, CEO John Gray told Bloomberg that Blackstone, expects inflation to be stickier than expected, forcing the Fed to be more aggressive than the markets currently think. And so stocks whipped around all day, swinging from positive to negative, back to positive, back to negative, back to positive again, as investors try to price all this in as the speculation builds around what the Fed is going to do next week. Yes, it's now assumed that we're getting a 75 basis point rate hike on Wednesday, taking Fed funds to 2.5%. But what will he say in the press conference? Will we see another 75 hike in September? Fed fund futures are suggesting yes, we will. And so that gets us up to 3.25% by the fall, leaving just 2 more meetings this year for the Fed to decide whether or not the hikes are working and inflation is responding. By the end of the day, the Dow added 162 points or 0.5%. The S&P up 40 or 1 full percent. The Nasdaq added 162 or 1.4%. The Russell tacked on 9 points or 0.5%. And the transports gave up 54 points or 0.4%. The Treasury curve remains inverted, with the 2s yielding 3.05, the 5 yielding 2.92, and the 10s yielding 2.81. The inversion is now 2 full weeks old, so the idea that a recession can be avoided continues to slip away. And no matter where you are in the risk scale, you have to recognize that it's coming. Now you need to ask, how long and how deep could a recession be? Because that's certainly going to be part of the conversation. Oil continues to trade right in line around $96.50 a barrel, leaving it solidly between trend lines at 87 on the downside, 100 on the upside. The idea that demand is weakening in the U.S., we are the world's biggest consumer of oil, along with new supply coming from Libya, helped to keep oil in line. Data this week reveals that gasoline demand in the U.S. has dropped by 8% year over year as prices rose to record levels, all during what is usually a high-demand summer driving season. And that's good news for consumers, as the price at the pump is now averaging about $4.52 a gallon versus the $5.25 a gallon last month. Demand, though, in Asia and India continues to build, with total refined consumption rising 18% year over year in India alone. And then snap! Oh, God, they reported after the bell, and was it ugly? They missed on already slashed expectations, missing on every potential metric. Advertising revenue slumped, so the aftermarket trading community just slammed it. Let me define that. They took the stock down 27% within minutes of the report, and this morning the stock is quoted at $11.85, $11.90, right around last night's close. In the aftermarket close, down 7%. It is now off 87% from its 2021 high. And although users were a bit above, it was ad sales that blew the company up. Demand growth on the advertising platform slowed significantly. Forward-looking visibility remains challenging, and this report is now dragging down all the other social media names. Facebook, which changed its name and symbol to Meta, M-E-T-A, is quoted down 5% this morning. Twitter down 3%. Pins down 7%. This morning, U.S. futures are indicating a lower opening. Dow futures were up 30. They're actually now up 60. S&Ps were down 8. They're now up 5. The Nasdaq lower by 60. I think snap. And the Russell is off by 3 or 4 points. Eco data today includes the S&P Global U.S. Manufacturing PMI and Services PMI. 52 and 52.7% respectively is what we expect. This would put both reads weaker than last month, as the trend is down. Recall 50 is the dividing line. South of 50 puts us in contraction territory. And the one that's the key to watch is the services number. Why? Because the U.S. is a 75% services economy. It's another big day for earnings, so we're watching for American Express, Schlumberger, Verizon, and Twitter all before the bell. There's no aftermarket reports. Look, it's Friday. Give me a break, right? Now, expect Twitter to be the one filling the airwaves today, right? Do people really care about the fundamentals at this point? Can you even believe the fundamentals at this point, considering all the bots and all that crap that's going on? In the end, while the drama around Twitter is exciting, you are in this market to make money, and there are plenty of other places to put your money that actually provide opportunity. In my opinion, Twitter is dead money for any long-term investor. Don't waste your time. There are so many opportunities that's going to help your money go to work. Twitter is just not one of them, in my opinion. European markets are choppy, but they are high this morning. All markets across the Eurozone up about 0.3. Eurozone business activity unexpectedly shrank in July. Manufacturing and service sector growth slowed. The composite Eurozone PMI, which includes both manufacturing and services, pierced 50, coming in at 49.4, which means what? Which means we're in contraction territory. The zone now joins both Germany and France that have seen their individual PMIs enter that contraction zone as well. Maybe someone should go knocking on the door at the ECB and tell Christine Lagarde that there's something going on in Europe, considering she doesn't think there's anything happening. UK PMI comes in at 52.8, down from 53.7, while the British consumer confidence remains at record lows at minus 41. Big inflation and rising interest rates. Minus 41 is well below levels that have previously been seen before as they enter a recession. So here it comes. The S&P closed at 39.98 after testing as high as 39.99, spot 29. Just a hair below the next century mark of 4,000. Now, as you know, I've been saying that we're in this 3,600, 4,000 trading range, and here we are. Now, if you look at the chart, you're going to see that it gapped down. The S&P gapped down on the opening on June 10th, going from 4,017 to 3,974, and gapped down again on the 11th, going from 3,900 to 3,838. We filled the gap created on the 11th, and will most likely fill the gap created on the 10th this morning. The S&P needs to trade up to at least 4,018 to fill that gap, and it needs to trade there, not gap up there. If it does, then that's going to be a bullish signal and could see us trade to the trend line at 41.40 over the next couple of weeks. Something I'm not really sure is going to happen, but it could. Remember, we still have 3 weeks left in the earnings season. We have the Fed meeting next week and a lot of economic data points. One of the most important is next Friday's PCE deflator, right? Which is the Fed's favorite inflation gauge, and that's expected to come in at plus 0.9% month over month and up 6.6% year over year, both higher than last month. And that will confirm what we learned from last week's CPI and PPI reports, which raced to higher highs. Remember, we're in this quiet period. Don't expect to hear anything formal from any Fed member, but it is the weekend. And you never know if Minneapolis Fed President Neely Kashkari, who's not an FOMC member, is going to make a call to his friends at Goldman Sachs to leak a story indicating what the Fed will do on Wednesday so that they can control the narrative, sending stocks higher. In any event, what's for dinner? Okay, so we're having the pan-seared ribeye bathed in butter. Butter. I love that, just like the way Barbara Streisand would say it, butter. Okay, this is simple. It's mouth-watering, but you need a thick cast iron pan that can go into the oven from the stovetop and back to the stovetop. For this, you need one 1-pound ribeye. You need peanut oil, kosher salt, black pepper, 3 crushed garlic cloves, and a stick of butter. You want to preheat the oven to 450 degrees. You want to put the cast iron pan in the oven with nothing in it. Just put the pan in the oven and let it get hot, right? You want the whole thing to get hot. Now, using some of the peanut oil, massage the ribeye on both sides. Turn it over, flip it over, rub it all nice and well. Make sure you massage it. Season it with the kosher salt and the black pepper. Now, set it aside just on a plate until you take the pan out of the oven when it's nice and hot. Once the cast iron pan is hot throughout, take it out of the oven. Remember, use your mitts because it's going to be hot. And place it on the stovetop burner, which you have set to medium. Now, take the ribeye, put it in the skillet, and let it sizzle for 2 minutes. You're going to hear it sizzle, right? Now, after 2 minutes, flip the steak. top it with the crushed garlic, and place the whole thing back in the oven and let it cook for 7 minutes. Now, depending on the thickness, so you have to kind of use your head here. Now, after 7 minutes, remove it from the oven. Put it back on the stovetop. Flip the steak over and add the butter, right? I'm going to say really a half a stick should really do. Cut it up. The butter will melt immediately. Tilt the pan, and then using a spoon, take the butter and just put it over the steak and let it drip off, and keep putting it over the steak. Then cover it, let the steak rest for 5 minutes. Serve this with your favorite veggie or potato, a large mixed green salad, and a nice, robust bottle of red wine. Here is where I would drink the Brunello di Montalcino. It's like velvet. This dish should probably cost you about $22 to $25 per person, plus the wine, right? The wine's not included in that price, depending on your taste in Brunello di Montalcino. You could spend $50, you could spend $150, so it's your call. But the dish itself, for the steak and the veggies and the salad, should probably cost you around $20 or $22 per person in any event. It's a really delicious meal. The steak is so delicious when you serve it like that. All right, it is Friday. The morning is about to get started. The opening bell is about to ring. Until Monday, take good care.